After the various headwinds of 2023, investors are now reassessing their investment strategies and are trying to find the best risk-reward investment opportunities. Our conviction is that climate impact infrastructure debt is particularly relevant to fulfill the current investor needs. To understand why climate impact infrastructure debt is particularly relevant in today's market configuration, let's look at the main concern of investors today. Today, there are three main concerns. The first main concern is resilience. Investors want to invest in an asset class which can be resilient in the current macroeconomic context. What's the backdrop for 2024? Still high level of interest rates and high inflation, volatility in the liquid market, and increasing geopolitical tension and difficult macroeconomic environment. Infrastructure debt is a defensive asset class which has proven its resilience and offers good protections against inflation, thanks to the essential nature of the assets that benefit from high barrier to entry and supportive regulatory framework. Cash flows of infrastructure assets are also less tied to economic cycles compared to other asset classes. The second main concern for investors is profitability, or rather risk-adjusted profitability. Investors want to invest in funds that offer a good risk-adjusted profitability and low default rate. Infrastructure debt offers today stable yield from 5 to 6% with no dependence on exit multiple. Our asset class has directly benefited from the increasing interest rate context, as it is a rate plus spread market. The illiquidity or complexity premium is still attractive for asset managers that are able to capture the alpha of the private markets. The low default rate of the asset class has been proven during the COVID crisis, and the value of the security package enables infra debt to offer higher recovery rate compared to other asset classes. Third concern for investors, decarbonization and ESG. Investors also want to invest in assets that can have a positive and measurable contribution to meet the energy transition and net zero challenges. Financial performance is a prerequisite, but ESG and impact are cherry on the cake. The massive investment need to meet the climate change challenges offers massive and diversified investment opportunities in the infrastructure space. We do not only need to build new renewable energy capacities, but we also need to finance new and innovative sectors such as hydrogen, battery storage, energy efficiencies projects. Track record and expertise of asset manager will be key to define the financing structure in line with the risk profile of those assets. Experience in ESG analysis and ability to measure the impact KPIs are also crucial to produce meaningful ESG reporting for investors. Given investor focus on these three concerns, we believe that climate impact infrastructure debt is truly relevant in today's context.